Most people think a reverse mortgage is based on how much equity you have. That's not quite right. Your loan amount actually comes from three things: your age, current interest rates, and your home's appraised value. Equity still matters, but only in one place, making sure there's enough left over to pay off what you already owe. Get that distinction, and almost everything else about this loan makes more sense. By the end of this video, you'll know the three things that actually determine how a reverse mortgage works for you: the mechanics of the loan itself, what you're required to keep up with once you have it, and whether it's actually a fit for your situation. In this video, I'm going to walk you through the three things every homeowner needs to understand before looking into a reverse mortgage, using the same framework I sit down with my clients and go through, face to face, across my desk. If you've read anything about reverse mortgages online, you've probably seen them described as trading your equity for cash. That's not the full picture. Your loan amount is calculated from your age, current rates, and your home's appraised value, not from your equity balance. Equity comes into play after that number is set to determine whether it's enough to pay off your existing mortgage. So it's not that equity doesn't matter, it's that it's not what determines your loan amount in the first place. A reverse mortgage is still a mortgage. For the federally insured version, a HECM, it's available to homeowners 62 and older, and it works a lot like a cash-out refinance. You qualify for a loan amount based on your age, your home's appraised value, and your current interest rates. From that loan amount, your existing mortgage and other liens against the property get paid off first. Whatever is left over is yours. So if the amount you qualify for isn't enough to pay off what you currently own, the loan isn't going to work for you yet. That's the piece a lot of people miss. It's not that your equity is being handed to you, it's that you need enough of it for the math to pencil out. Now, that doesn't automatically mean you're out of luck. If there's a shortfall, meaning the loan amount doesn't quite cover what is owed, you can still move forward. You just need to bring the difference to closing out of your own funds. It happens more than you'd think, and it's usually a lot smaller gap than people expect. Once your existing mortgage is paid off, here's where things start to look different from a regular loan. You're no longer required to make a monthly payment. You can if you want to. That's called a voluntary payment option. But most people don't. And when you don't make a payment, that interest that accrues that month simply gets added back to your loan balance instead of coming out of your pocket. Your balance grows a little bit every month, and that's the trade-off for not having a required payment. Two more things worth knowing here. If rates move between when you apply and when you close, you get whichever rate benefits you more. And this loan is non-recourse, which means neither you nor your heirs can ever owe more than the home is worth when it's time to repay. The federal insurance covers that gap. With a regular cash-out refinance, you get one lump sum and that's the whole transaction. A reverse mortgage gives you four ways to structure it, and picking the right one matters more than most people realize going into it. The first option is a lump sum, all the available funds at closing. That tends to make sense if you're using the loan to pay off a large existing mortgage or handle a specific immediate expense. One thing worth knowing here, the lump sum isn't always the full amount you qualify for right away. Depending on the specific product, there can be a limit on how much you draw in the first year. Generally, your mandatory obligations like paying off your existing mortgage, plus an additional 10%. This varies by product type, so it's not a one-size-fits-all number, but it's worth knowing going in that lump sum doesn't always mean everything all at once. The second is monthly payment to yourself, structured either for a set number of years or for as long as you live in the home. That works well if you're using the loan to supplement retirement income on an ongoing basis. The third is a line of credit, and this is the one people underestimate. You only pay interest on what you actually draw. And the unused portion doesn't just sit there. It grows over time at the same rate, the loan balance would have grown, which means your available credit can actually increase year after year, even though your home's value isn't part of that calculation. For homeowners who don't need the money right now, but want it for safety net later, that growth feature is often the most valuable part of the entire loan. And the fourth option is a combination of any of the three. Some lump sum for immediate need, a line of credit for the future, monthly payments layered on top. That's usually where the more detailed planning conversation happens because the right mix depends on your specific retirement picture. And qualifying isn't a one-time event. There are things you have to keep up with for as long as you have the loan. And this is the part that causes almost all the bad stories you've probably heard. To start, you need to be 62 or older on the federally insured reverse mortgage, the HECM. If you're married and your spouse is younger than 62, that's not a deal breaker. The younger spouse is what's called a non-borrowing spouse. And there are specific protections in place that let them stay in the home in certain situations where the borrowing spouse can no longer live there. It's a nuanced topic, so if that applies to you, that's a conversation worth having directly. The home itself has to be your primary residence, meaning you live there for more than half the year. Single-family homes, 2 to 4 unit properties where you live in one unit, and certain condos and manufactured homes all qualify. Now, here's the part that matters most. You keep paying your property taxes, your homeowner's insurance, and your HOA dues if you have them. This is a requirement that, when if not met, leads to foreclosure. And it's worth saying that this isn't unique to reverse mortgages. Any mortgage can be foreclosed on if you stop paying taxes, insurance, or HOA dues. The difference is that with a reverse mortgage, there are no monthly payments to serve as a reminder, so it's on you and your family to stay on top of it. As for when the loan comes due, when the last remaining borrower permanently leaves a home, whether that's selling, passing away, or moving into a long-term care, at that point, the balance, whatever was borrowed plus the interest that accrues, needs to be repaid. Usually that happens through selling the home, refinancing it, paying it off with any other funds. Whatever equity is left after that belongs to you and your heirs. If this is helping connect some dots, hit subscribe and drop a comment with a question if you still have one about reverse mortgages. I read every one and it helps me figure out what to cover next. Two things come up in almost every first conversation I have, and both of them are wrong. The first is that you lose ownership of your home. You don't. Title stays in your name the same way it does with any other mortgage. A reverse mortgage is a lien against the property, not the transfer of ownership. The second is that you're automatically giving up your kids' inheritance. Here's why that's not accurate either. Yes, your loan balance grows over time if you're not making payments, but your home's value is very likely growing over that same stretch of time. Whether there's equity left at the end depends on how those two things move relative to each other, not on some fixed rule that says there won't be. There's always some risk of ending up upside down on any loan with a growing balance. That's real, but it's not the guaranteed outcome people assume it is. And because this loan is non-recourse, even in that scenario, your heirs will never be on the hook to cover the difference out of pocket. A reverse mortgage isn't and shouldn't be a last resort. It's also not for everyone. Both of those things are true at once. It tends to make the most sense for homeowners who plan to stay in their home long-term, who have a significant amount of their net worth tied up in the house with no other way to access it, or who are worried about their retirement income not being able to stretch as far as they need it to. It can also be a smart tool even for retirees who are financially comfortable as a way to manage sequence of returns risk or give them other retirement assets room to grow. That's a conversation I have often with financial advisors, not just homeowners. On the other side, it's probably not the right fit if you're planning to move in the next few years, if the numbers don't leave you in a meaningfully better situation, or if you don't fully understand how the loan works yet. The last one is the most important. Understand the mechanics first. The decision gets a lot easier once you do. So the three things: your loan amount comes from your age, current rates, and your home's appraised value, with the equity checked afterward to make sure the math works, including how you can structure the payout itself and what's available to you in that first year. You have ongoing obligations, mainly taxes, insurance, HOA dues, and that's what actually protects you from the foreclosure horror stories, not some hidden catch. And it's a fit for some situations and not others. And knowing which one you're in matters more than any sales pitch or any myths you've heard secondhand. If you want to see what this actually looks like with your numbers, your home, your age, your goals, book a call with me. I'll walk you through the real math. No pressure, no obligation. Links in the description.